Okay, another one where you're going to have to excuse me because I'm going to bullet through it. And the reason is we're a bit short on space on the CD, but I do want to give you all the rules in one go. This one is learn to short. That means profit from falling prices. This is where you sell something first and buy it back cheaper later. Why would you want to learn how to do this through spread betting or CFDs or through options and the other ways, assuming it suits your risk profile? Well, let me tell you why. If you invested $1,000 in the Dow Jones Industrial Average in '66, reinvested all the dividends and allowing for inflation, guess what percentage return you'd have by 1994? I'll tell you, nothing. 0% return over such a long time frame. If you bought Coca-Cola and Disney in '72, it'd be 1985 before you got a return. That's why. These are major US indices. Look at the time frames there. Look at the prolonged periods of time when all they do is fall, fall, fall. Grandma's waiting a long time to get a return. Look at this, Ambuscap, typical UK stock going sideways for a very long period of time. Well, if you can short, then you can make profits from that, as well as what only investors do, which is make profits from that. You can make a profit from that one, as well as that one. And this. In other words, what's happened? All of a sudden, instead of 1, 2 opportunities, you've got 3, you've got 4, and you've got 5. You've got 5 opportunities. You've more than doubled your opportunities to make a profit. That's a sideways market. You just made 5 times as much in a sideways market than you would have done by doing just buy and hold, or by only going long, which is this. Isn't that a great reason to learn how to short? Well, what are the ways of doing it? Well, one of the ways we've got to look at is CFDs, we've got to look at spread bets, we've got to look at options, we've got to look at covered warrants and stock futures. Now don't mind this graph here for a second. What this picture shows you, which I won't go through for a moment, is how when you're using margin, which is leverage, that's when you only put down, say, 10% instead of a whole 100% of the cost of a stock, how the returns can magnify. 400% returns instead of 40, but also the losses can as well. Let's not forget that. That's why we've got to learn about risk and money management, but also, more importantly, look at how we can turn 40% into 400% if we're willing to take the risk, and we can cut the risks short, which is what we've got to learn how to do by using these kind of products, which, as well as teaching us how to short, they also give us margin and leverage, and you'll have heard of these products. But you've seen the reasons why I've said that they're important things to learn. Next up is rule number 11.